Before we get into it, this is not financial advice. I am a self-taught investor sharing my process. Do your own due diligence. You make your own call. Chevron returned $6.1 billion to shareholders last quarter. It earned $2.2 billion. That gap was funded with commercial paper. That is short-term debt that has to keep rolling over. The stock trades at 33 times trailing earnings, but those earnings are at a cyclical low, and the asset base just changed with the $53 billion Hess acquisition. Today we look at every number. You decide, and if you find this useful, the like button is right there. It costs you nothing, and it helps this channel grow. Chevron is an integrated oil and gas company. It operates in Upstream, which finds and produces crude, and Downstream, which refines and sells it. In July of 2025, it closed a $53 billion acquisition of Hess, adding the Stabroek block in Guyana. 11 billion barrels of oil equivalent discovered. Production hit a record 3.86 million barrels per day in the first quarter. That is the new baseline. Chevron hit a 52-week high of 214.71 in March. It sits at 182.20 today, down 15.1%. That is a moderate decline for an oil major. The market repriced the thesis. The business did not break. Trailing 12 months through March 31st. Revenue $190 billion. Net income $11 billion. Free cash flow $13.8 billion against $11 billion of net income. The cash exceeds the profit. After subtracting $472 million in stock-based compensation, owner earnings stand at $13.3 billion. That is what the business generates for you as an owner. Total assets $329 billion. Liabilities $140 billion. Equity $189 billion. Total debt $45.4 billion. Cash $5.3 billion. Net debt $40.1 billion. Goodwill $4.6 billion, mostly from Hess. Debt to EBITDA is 1.1 times. Leverage manageable, but watch it. Chevron returned $6.1 billion to shareholders last quarter, $2.6 billion in buybacks, $3.5 billion in dividends. It earned $2.2 billion. The gap was funded by adding $4.7 billion in commercial paper. Capital returns partially financed with debt. That is the margin story. Hold that thought. Upstream earnings $12.8 billion, down 31% year over year. Lower oil prices. Downstream earnings $3 billion, up 75%. Better refining margins. Hess integration is underway. Guyana Waru production is expected to ramp in the second half of this year. That inflection will determine whether the downstream recovery is enough to offset upstream headwinds. On trailing earnings of $5.54 a share, the PE is 33, backward looking before the oil spike. Forward consensus now sits near $13 a share. That is about 14 times, cheap for a major. But that consensus bakes in elevated oil. If crude normalizes, earnings power falls back toward $8 or $9, and the multiple climbs past 20. Same company, 3 multiples. The only variable is oil. First, $34 billion remaining in the buyback authorization. No expiration. Management is buying aggressively. Second, the Kilby data center deal with Microsoft could add $5 to $10 billion in potential EBITDA. 20-year power contract, turning natural gas into contracted AI infrastructure revenue. Third, Guyana production ramps in the second half. That is where the cash flow inflection comes. First, returns funded by debt, $4.7 billion added in commercial paper last quarter alone, buybacks and dividends outpacing earnings. Second, 33 times trailing earnings on a cyclical trough. Oil at $60 changes the math dramatically. Third, the commercial paper market has to keep rolling over $5.8 billion in short-term debt. Leverage in disguise. Every stock in the think tank gets measured against gold. At 182.20, a share with gold at 4,025, that is 0.0453 ounces per share. 2 charts, 1 story. The ratio just posted an oversold bounce. Gold looks extended after its run. If gold cools while the ratio firms, Chevron gets cheaper in gold twice over. Dollar prices lie. Gold ounces are honest. Valuation, fair at normalized earnings. Balance sheet, stretched after the debt-funded quarter. Margin trend, recovering downstream. Revenue growth, flat. Smart money, Institutional holders steady. Short interest low. Risk elevated on debt-funded returns and oil exposure. Verdict, transition. The thesis is intact, but the execution window is narrow. I show you the data. You make the call. That is the Chevron thesis. One stock, one scorecard. Every number sourced from primary filings. Chevron reports July 31st. We will know soon. If you want to follow along as this plays out, subscribe and hit the bell. This is the Think Tank Trader, not financial advice, just a self-taught investor sharing the process. See you next episode.